Welcome. Monday night stock market. I am Godric, stock market mentor. Your stock market mentor here, Godric. Monday night, October 2nd, 2023, 10:56 p.m. Pacific time. We covered some positions last week. We're going to review this week. Stock market happening tonight. We're going to cover some positions. We talked about our core 10 stocks list. We're going to review our core 10 stocks list. Going to look at some options, some option chain, some cover calls, puts, calls, stocks, shares, stock market mentoring happening tonight. You guys like the live, get some people in here. I will answer questions best I can about your stocks. I do stock evaluation. Don't get mad if I tell you your stock is trash. Okay, so let's see. Last week we covered. What did we cover? We covered AMD. I got notes on that. We covered Tesla, Netflix, AMD, Chipotle, Apple, Philip Morris, Skechers, Starbucks, NVIDIA. That's 9. You guys took notes. If you didn't, I have the full video on my YouTube. My YouTube is in my profile. Check it out. Give me a follow there too. So, welcome. Hit the like button. Get some people in here. Stock market Monday nights. Okay, so TD Ameritrade is moving over to Schwab. I guess Schwab bought them, or it's a merger. Same thing, basically. The Schwab, though, is the parent company, so it is a merger. I'm just hoping that we don't lose our cool bells and whistles we got from TD Ameritrade, because Schwab, honestly, what I've seen and heard is not as good as TD Ameritrade as far as the platforms, the trading platforms, and tools, and also the customer service. I think Schwab has more money. It's probably why they bought TD Ameritrade. Everything is basically monopoly. Everybody gobbles up everybody else. You know how that goes. So TD Ameritrade is moving into Schwab, and they're going to transfer our accounts by next week. Next month, actually. So that's happening. Let's start with Palo Alto Networks, PANW. We covered it a little bit last week. I want to look at the option chain and why it's good, why the stock is good. Let's go over some criteria. I appreciate if you do share the live. Give me some likes. I'm going to get some people in here. No questions yet. I don't see any questions yet. Okay, so PANW. Share price $236.77. Up to 33 today. Which it's been maintaining the 6-month chart on Palo Alto. It goes from about 200 to 240. So it has broken some new highs in the last 6 months. That's good. It's breaking out. Should continue to break out. There's some price targets on Palo Alto up higher, 250, 275. I like the market cap, 73 billion. Write that down. 73 billion is good because it's not tiny, but it's not huge. It's kind of like a growing company, which is a decent size and growing. That's important. I like my minimum to be about 50 billion. 73 billion is pretty decent. They're not so big like they can't grow, but they're not too small where they're gonna get blown away if there's like a pandemic or if there's some kind of economical correction. I also look at so we have the share price. The share price I think is important. If we're gonna get $100 share price, I'm pretty happy. $200 even better. A high share price is better because it has proven itself by going up and up. A lot of people will tell you, a lot of traders will tell you, oh, share price doesn't matter. But if you have a $5 stock, why is it so low? Like, where did it go? Probably went down. If you have a, Palo Alto, $236. Just look at the 10-year chart. I'm going to pull that up. And we go from anywhere from around 36 to 250. Let's see if I can get the calculator out for you. So what you do is you go you go 250 divided by 36. 6.9 times. So it went up about 7-fold in 10 years. So Palo Alto times 7 in 10 years. 1,000 becomes 7,000. 100,000 becomes 700,000. So that's your return. I want to have a stock that's gone up in 10 years. I want to have a profit in 10 years. It should be pretty decisive on that front. And Palo Alto it recently broke some new highs, some all-time highs, which is to say that it's in an uptrend. It's going up. And for me, trends rule investing. You want to have your stock. You want to have your stock on a good trend. If the trend is down, be careful. Like if it's going down over 3 or 5 years, then you got to be really watch it, because then you're losing favor in the market. Investors are selling, traders are selling. So Palo Alto went up 7-fold in 10 years. 237 share price, 73 billion market cap. Volume, let's look at volume. I know you guys know that I'm a volume guy. I want to get my volume in my stock. I like to have about 2 million a day. And Palo Alto has average 10-day volume 2.5 million. 2.5 million. So far, they're all good. Share price, check. Market cap, check. 10-year chart, going up over time, making money over time, check. Volume, check. 2.5 million. Let's do PE. PE, does it make profit? Let's see. PE of 185, yes. This is a very high PE, which means it's priced very high. However, don't let that steer you away. An average of good PE is around 20, but I like my PE to be about 28, 30 and up, because then the shares, the stock is favored by the market. It's trading at a higher multiple. So PE put 20 to 28 plus. You can put 50, 100 plus. And Palo Alto will pan out. It will probably get down to around 30 or 50 PE once they get their earnings consistent. So that's the earnings. If you have earnings that's a dash or a zero, that means they're losing money. Stay away. I understand the idea of investing in a stock that's losing money, but like, how much money of your hard-earned money can you put in a company that's losing money, right? So that's a red flag. So we got share price high, check. Market cap 73 billion, check. 10-year chart went up 7 times, check. Volume 2.5 million, check. PE is profitable, check. 1, 2, 3, 4, 5. That's 5. We can do one more. We'll do 6 criteria today. 6 would be the covered calls, or the option chain. Option chain is like if the puts and calls are paying, the premiums are nice, and like 3 to 5% per month. You can get a 3 to 5% per month return on your covered call or your naked put, for example. That's a green flag. That's a great thing, because you can write covered calls, earn money, pay your monthly bills. Jasper wants some rubbies. Okay, so we got 6 criteria today. Let me see if I can. I have, without messing up my screen, I'm just gonna read you. I'm gonna read you the option chain. So you click on stock, click on option chain. Gotta make sure that you have to set it for. It says range, not near the money, but all. You want all the options, and then hit view chain. Now it's October, so we go to November. Now, generally we do month-to-month cover calls or naked puts or writing options, but we're going to go, this time it's going to be 7 weeks. Generally it's 3. When you do a cover call, it's 3 to 7 weeks. And since we're already in October, we could write October, but it's only like 2.5 weeks, so I'm going to push it to November. And November, we always go the 3rd Friday. So the monthly, we go monthlies because they have more volume. Makes sense. Give me some likes, guys. Get some people in here. Share the live. Appreciate you. No questions yet. Okay, so now options. So there's like 1,000 options per each stock, but we want to use the options that pertain to us. In the cover call scenario, we're gonna go with the share price of 236. So we're gonna write the cover call above that. Let's say the 240 for November is 11.25. The 250 is 7. Here's a scenario where you can write, if you can get 200 shares, you can write 1 240 and 1 250, because it's right there in between. Like, the sweet spot would be like for the premium, which is your monthly return, to equal the distance from the stock price to the strike price of the option that you're going to write the call, which means that we agree to sell the stock. In this case, if it's for 240, and we're going to get paid $1,100 for that. The 240, write this down, 240 CC, 1125 by 1145. And the 250 CC is 710 by 725. And when I say 1125 and 710, that's 1,000. It's times 100 because we're doing one contract at a time. So 1125 is $1,125. Cover call for Palo Alto, PANW. And if you write the 250, that's going to be $710 for the 250 strike for November, PANW. So let's do some math, okay? So we invest, in this case, $23,677 by 100 shares of Palo Alto today or tomorrow. And then we're going to write one cover call on the 240. In this case, we have a share growth potential of $3.23. SG is a share growth, 323. Because why? Because we had the shares at 236. We agreed to sell the shares at 240. 236 and 77 cents. So that distance is 323. So we can make $323 more by the stock price going up. And then if it passes 240, it could sell. We can cash out at 240. And for that, we get paid $11.25 per share, or $1,125 per 100 shares. Forgot to catch that? Let's do the math on that. We put in the premium first. 11.25 divided by the share price, which is our investment, 236.77 equals it's 0.0475, which equates to, move the decimal over twice to the right, 4.75% return, which is a great return. We can do that 10 times a year. That's 47% a year, but we'll probably end up getting less because there's things that happen. Sometimes the share price goes down, or the stock goes up and we have to pay more for it. But if we're getting 475 in 7 weeks, we can think of it like this. There's 52 weeks in a year, divided by 7. We can do 7 cover calls on that. So 4.75 times 7, 33% return. Not bad. I never count the share growth because it can go up or it can go down. So that's just a bonus if it goes up or if it maintains. But if the stock goes down, then we're going to be basically bringing the premium in this case $1,100. But then our shares may come down. Let's say they go down 10 points. Let's say they go down from 236 to 226. Well, then we're out 10 points, which is $1,000 because that's 100 shares. And then we're going to get the premium of $1,100. We're going to be in profit mode by 125. So a cover call trader is generally much better off than the standard trader who doesn't write cover calls, because in the case where the stock comes down, the cover call investor will lose the share growth as the shareholders will. The shareholders that don't write cover calls, but they're going to be getting the premium, in this case $1,125, and that's consistent. That could be consistent pretty much month to month. It goes down and up, but it's pretty consistent. And then that brings us from a loss mode to a profit mode. The downside is if the stock shoots up to 250, 260, 270, which it could happen, but probably not going to happen, but it could happen. We agreed to sell at 240, so we're going to be getting an additional. We calculated that $323 maximum. And I'm going to put down the premium $11.25 plus 323, 11.25. Maximum we're going to get is $14.48. And if you got $14.48 and you put divided by the share price, actually we'll do 14.48 divided by the share price. 236.77. 6.11% return. 6.11 or 6.12% return. So the return goes up if you get the share growth, if the stock goes up. But if Palo Alto were to go to, let's say, 260, let's say it shoots up, the shareholders will get 236 to 260. That's about 24 points. That's 2,400, right? And if we want to do 2,400 divided by 236.77, that's 10%. 10% return. So in that case, the shareholders did better than the covered call writers. But here's the thing, guys. The stock is not going to shoot up every month. Matter of fact, it probably won't shoot up but once or twice in a year. And even when it shoots up, it tends to come back down. So the theory behind the covered calls is that continual, some of the upside is much better than just holding the shares, hoping for it to go to the moon, and having no consistent income, no consistent covered calls or naked puts. In this case, just covered calls. The theory is that those covered calls, in this case $1,000 every 7 weeks, $1,100 every 7 weeks, is going to outperform the share price. You're going to get income. You're going to beat the market. You're going to be able to pay your bills. You're going to be able to, what's the goal? Retire into the stock market. That's the goal. Certified mail coach. Welcome, guys. Welcome. Give me some likes. Share the live. Right. If you have a question, put it right here. I'll check out your stock for you. I can evaluate your stock. Okay, so that's the cover call for Palo Alto. I want to also do the 250 strike because why? Because Palo Alto is right in the price range where I would like to do a 245, but there isn't a 245, there's a 250. And I'll tell you why. Because should the stock go up to say 260 or just shoot up, we're only going to get in the first instance, if we sell the 240 cover call, we're only going to get 323 share growth. But I want more share growth because Palo Alto is on an uptrend. It's hit some new highs. And it could go higher. So I'm going to also sell the 250. So this strategy is to have 200 shares. One cover call the 240, one cover call the 250. That's going to cost twice as much. So 23,667, 23,667 plus, actually times 2, 47,334. Now I know you have 47,000. I mean, don't you? If you don't, start selling all the shit in your garage. Save like it's a religion. But if we can get the other 100 shares, we're going to balance it out with a 250 cover call for November on Palo Alto, PANW. And we're going to get 710 by 725. I'm going to just say 710. That's $710. And the share growth there is going to be an extra 10 points, so 1323 share growth. So the stock shoots up, which it might. One of these months it will shoot up, probably. then we're going to be able to get that 1300 instead of just the 323 on the 240. We get 1300 on the 250 because we agree to sell it at 250. And let's average out these two. So we got 1125 coming from 100 shares, the first 100 shares, and then we have 710 coming from the second 100 shares. 7.1 divided by the share price 236.77. We got 2.998%. 3%. Is that close enough? 3% return on the 250. And we already said it was a 4.75% return on the 240. So let's average out the two. Let's add 710 plus 1125. Add these two together. 710 plus 1125. 1835. So we have 1835 premium income, $1,800. And we know our investment is twice the share price because we're going 200 shares in this case. So divided by 473.34. The average is going to be 3.87% or 3.9% average return. We can do that 7 times. Because why? Because it's a 7-week trade. 52 weeks divided by 7 is 7.4. I'll give you the extra time on the 0.4. So 3.9% return times 7 trades in a year. We get 27% return. 27% return, and we get more share growth. There you go. That's what I like to do on Palo Alto. So this one is a little bit bigger investment. We do have solid premiums, decent premiums, 4%, 3%. I mean, it has all of our 6 boxes. It has share price. It has volume. It has market cap, 10-year chart, PE, profit, cover call return. That's 6 out of 6. 6 for 6. 6 for 6 boxes. I can look at these other ratings. I mean, these other ratings are kind of strict. I'll tell you that right now. But the Smart Score for TD, powered by Tip Ranks, the Smart Score for Palo Alto is 9 out of 1 to 10. So that's good. Reports and ratings, research team. You guys, if you want to give me a question, I'll try my best to answer your questions about stock market. Give me some likes. Appreciate it. So, reports and ratings. Research team, reduce. So that's a negative. New constructs, 4th place out of 5. So that's low. The street is a buy. On a buy wholesale, that's a positive. CFRA is a 5-star, which is the best. Fort Equity Research is a 2nd place out of 5. That's good. And the market edge is avoid. So we got 9, which is 1, 2, 3, 4 positives and 1, 2, 3 negatives. So, you know, I think most of these research guys, they tend to be wrong. But what happens is they do sway investors and traders. So that kind of indirectly affects the stock, because if so and so are giving buy ratings and hold by positive stuff, then the traders are going to look at that and they're going to kind of like be influenced by it, at least to some degree. So in this case, overall, positive 4 out of 3, or should I say 4 out of 7 positive. It has all of our boxes. TikToc.com. Welcome. Welcome, guys. Which one are we talking about right now? Palo Alto Networks. PANW. K888. Did I say it right? Welcome. Have any questions for me? I can do my best to evaluate your stock, or, if you have any other questions. I do stock market Monday nights. Come join me. Sorry, a little bit late tonight, but I had a big dinner, so I didn't want to. Gotta eat. So, Palo Alto has all around pretty decent. Let's go to next stock. We haven't covered Apple in a while. Let's look at Apple. We're going to exchange some premium for some stability. AAPL. Why? Because I know that Apple probably has all the boxes, but the cover call is going to be less, right? But like I said, like if you're a stock like Apple, like it's considered to be more stable. It's like too big to fail kind of thing. Like it's in 150 countries. Yeah, income, PE, all pretty solid. Huge. The market cap is 2.7 trillion. That's the biggest right now. Let's put it on our 6 Apple. Let's give it the test of 6, shall we? Share price 173, 75 cents, plus 254. When the market's kind of off, which it was a little bit off today, and if your stock is up, that's a really important indication. It means your stock bucked the trend and it outperformed the market. So you kind of like want your stocks to buck the trend in a good way. In this case, Apple and Palo Alto both went up when the market was down, when the Dow Jones was down. So that should be noted in your journals. So it has a share price, 173. A high share price is nice because, like we say, it performed by going up and up. I like share prices over 100, 100, 200, 300. Apple's 173. Great, healthy, nice share price. That's the first check. Next one, we know market cap is there. Market cap 2.7 trillion. I like over 50 billion, which is 50 billion being small, but not too small. This one, we're just getting more addicted to our cell phones. So it's almost like this is not going away, Welcome, Flyman. Welcome, guys. Give me some likes. Hit that screen for me. Let's get some more people in here. Okay. The third criteria we talked about is a 10-year chart. And if I pull that up, I know it's going to be good. Let's pull it up. I want our stocks, our investments to go up over 10 years pretty decisively. And we have about a $20 price for Apple 10 years ago. And it's 173 now. So let's see. 173 divided by 20. 865. 8.8 times. 8 to 9 times. I'm just going to put times 8. Eightfold. So in 10 years, your stock went up 8 times. $1,000 becomes $8,000. 100 grand becomes 800 grand. So you got that check box. Volume, daily volume. We know the volume's there for Apple. Our average daily volume is 56 million. Volume 56 million per day. I like about 2 million a day. 56 million is huge. Why is volume important? Because when your stock has heavy volume, it indicates a lot of investors, a lot of traders. Why is that good? Because when the shares dump or the stock market corrects or when the stock comes down, those traders are going to see the opportunity and go and swoop on Apple, swoop on your heavy volume stock when it's down, and they're going to buy it right back up, and it's going to save your ass. That's why it's good. That's why volume is important. Welcome, welcome. So we got the volume. What else? PE. Apple shows a 28. Look at that. I said I like 28 PE just because 28 is a lucky number for me, but also because it's like higher priced, higher valued. And Apple has a 28 PE. So got that checked. That's 4. We got 2 more. We're going to look at options. We're going to look at, what else? What's the 6th one? I cover call options, PE, volume, 10-year chart. 1, 2, 3, 4, 5, and the options are 6. So let's look at the option chain now. If the stock is 173, it's going to take $17,375 to buy 100 shares of Apple. And we can write the covered call. We buy these shares, let's say today or tomorrow. Let's pull up the option chain. Apple. All, near the money, put all. It's October, so we're going to go November. In this case, 7-week trade. 173 share price. We're going to probably sell the 175, honestly, to make it simple. We can sell the 175 and the 180 if you want. Let's just do that. Let's like we did Palo Alto. So 175 strike. I agree to sell the shares at 175. And the premium is going to be 615 by 625. That's for the 175, and then 180 is going to be 382, 385 by 390. Okay, so if we go ahead and sell the 175 cover call, we're going to get the premium 615, which is $615. So again, invest 17 grand, 17,375. Each 7 weeks or each month, we're going to do the cover call on Apple. In this case, we're getting 6.15 per share, $615. So we go 6.15 divided by the share price of 173 and 75 cents. 3.54% return. 3.5% return. Close enough. Not bad. If we multiply that by 7 weeks, we're going to get 24% return a year, which is great. I mean, you only have to make 10% to keep up with the bankers, to keep up are designed to get you to outperform the market, to beat the market. They can really help income, pay your bills. So again, we're going to buy 100 shares of Apple, write the 175 cover call for November. Get $615 or $615. Now $615, that could pay like for food. You pay a car note, for example. And if you think about it, like how many cover calls do you need to pay all your bills? That would be a good math number to find out. And then you can just go on and figure out how much money you need to write the cover call to pay all your bills. Get that magic number, right? So let's do 200 shares of Apple this time, just like we did with Palo Alto. We're gonna write the 180. I'm going to balance it out with 2 covered calls. Why? Because if we buy the shares at 173, I don't really want to sell off 175 because I'm only making, in this case, 173.75. I'm only making $1.25 on the share growth. So the stock shoots up to 180, 190. You're gonna kind of like wish like you didn't write the cover call, but you exchange that for monthly income, and that's why it's good. Because why? Because when the income is consistent, you can pay your bills with it. They just drop it in your account at the end of the month. Again, repeat. Pay your bills. Makes sense? Okay, so let's do the 180 cover call for Apple. It's going to give you 385 by 390, so $385. And that can pay a car note or some food or your electric bill, your cable bill. And then we're going to do the percent return on that. What you do, you take, put your calculator, 3.85 divided by the share price of 173 and 75 cents. 2.2% return. 2.2% return, which isn't great, but it's good. It's low for a cover call, but it's Apple. So like, if you're gonna invest in Apple, like the theory is like, the thinking is like, it's Apple, like where's it gonna go? So take less premium for more stability, right? If you're in like Palo Alto, some other company that it's like a roller coaster ride, Netflix, Tesla, these other ones we're doing, you're going to get much more premium, but you're going to be on a roller coaster ride, so you don't have that same stability, right? Tech stocks. I like to look at what? Tesla next. Let's average out these two. So we're going to get 615 from our 175 CC cover call and 385 for our 180 cover call. Let's add that up. 615 plus 385. 1,000. Wow. How nice. $1,000. And then that with 200 shares of Apple, it's going to be 173.75 times 2. 34.75. Oh, so 34,750. So this is what you do. You take the 2 cover call premiums, add them together, $1,000, divided by the share price of 200 shares, in this case, 34,750. It's going to give us 2.87%. Let's say 2.9%. Let's say 2.8% because you can screw it up and still do it. 2.8% return. Averaging the 175 call and the 180 call, which is $1,000 a month. Investment 34,750. But you gotta start saving money. I'm telling you. Sell your car. Do what you need to do. Sell the shit in your garage. Get asked for a raise. Start saving like it's a religion, because you gotta be stacking up these shares for these cover calls for the income. Why? So you can retire into the stock market. Any questions on that? Thank you, K888. I like 888 because it's lucky. It's auspicious. All right, let's look at Tesla. Why not? Tesla had some slack because why? Because they're showing articles about like digging through lithium mines, like burning thousands of gallons of gas to get an electric battery. And then once they have the battery, those batteries are going to have to go to landfill, and they're acidic, toxic. So not so environmentally friendly, but hey, it's Tesla. We like Tesla. We like Elon Musk. He's doing okay. He's trying. He's our big billionaire. Okay, so Tesla. Oh, real quick, let me do the ratings for Apple. I wanted to show you guys like what like these guys don't know what they're doing, right? Ratings, right? But I'm gonna read them to you because out of 1 to 10, the tip trans, the tip ranks, sorry, gives it an 8 out of 1 to 10. Smart score, an 8, and then welcome guys, welcome. Share the live, give me some likes, get some people in here. And then we have a we have a hold we have a hold on research team, so that's neutral. And new contracts we have a 3 out of 1 to 5. That's a neutral. So like Apple's like getting neutral ratings, just like like why the street has a buy. That's a good. The CFRA has a 4-star and a 5-star. That's good. Ford Equity Research has a second place out of 5. That's good. And then Market Edge, of course, Market Edge is a ball buster. Avoid, right? Why would you avoid Apple? Like, anyways, an 8. That's 1, 2, 3, 4 good ratings, 2 neutral ratings, and 1 bad rating. That's Apple. Okay, on the Tesla. Any questions on that? If you want to put your stock symbol in here, I'll look it up for you. Don't get mad if I tell you it's trash. But I do have 6 criteria tonight. I'm going over, and we're going to do Tesla next. Tesla share price $251 and 60 cents. You see, I'm consistent. I have share prices of $200, $173. Oh look, it's up today, plus 138. Why? Why if the Dow Jones is down 74 points? Well, technically it's flat, down 74, but still down. But Tesla up 138. Now Tesla's been kind of like banging around between let's say 25 and 275. So it's 251 today. Not like it's really going up, but it does have an uptrend. We'll do the 10-year chart to start off with. That is an uptrend. I know. Ooh, 2014. It's like I can't even see. It's so low. It's probably around $7. That's what it was around 10 years ago, and now $250. I mean, if it is 7, I can't see the exact price, but messages for me. Anybody? Share? Yeah, thank you for sharing. Give me some likes. Okay, if it is $7, I'm just guesstimate. 10 years ago at 2000, so you go 251.6 divided by 7. 35 times 35.9. 36 times, bro. 36 times your value. Like, how would you like to invest like $1,000 and have 36 grand in 10 years? I mean, it's true, it's a long time to wait, but like, what else can you do as an investor? 100 grand becomes 3.5 million. 35 times. I mean, like, if you take like Microsoft, I think from the beginning with all the stock splits, it was like 11 cents, so it's like 2,500 fold. So like $1 becomes 2,500. Like, you can just do the math on that. 100 grand, right? But anybody can. I mean, not anybody, but if you're lucky enough to have one of these companies that has done stellar, you're talking about 35-fold return on Tesla. Well, that's the second box. We have share price, good. 10-year chart, good. I like our market cap to be at least 50 billion. We know Tesla has that. Thank you. Share the live. Give me some likes. Tesla has 798 billion market cap. Let's just say 800 billion. 800 billion market cap. Check. That is an approval. I got an approval. I got a green light for Tesla. That's three. We have three more. We have PE. Let's see. Oh, profits 69. 69 PE. Appropriate. 69 PE check. That means they make money. If your PE is a dash or negative, they're losing money. Red flag. But if your PE is a positive, in this case 69, even though that's high, a good average PE is about 20. 69 is high, but hey, I'll take a 69. I mean, it's like what? Favored. It's priced at higher multiples. I'll take it. That's the fourth check. Now we have what? We have volume, and we have options. I will have you know that Tesla pays the highest options right now that I know of. I mean, there's some other stocks that are close, Roku, etc. But Tesla will be the winner today. Let me do the volume. 10-day average volume, 118 million. Wow, in one day. Why is volume good? Because when the stock dips, when the market corrects, all these traders, investors are going to swoop in and buy that stock lower, and to bring the price up, so save your ass, and that's why volume is good. And then the final is the option. So again, covered calls, buy 100 shares of Tesla. In this case, $25,160. Who doesn't have that? Who wasn't able to save that in, let's say, 5 years? Overtime, raise, better job. I'm just giving you guys some advice. Okay, save like it's a religion. Stop eating fast food. Eat at home. Look, buy a pack of meat, pack of pasta, some broccoli, mix it up all in there. For $10, you can have a nice dinner. Save yourself from having to spend gas, tip, that fancy restaurant. You know, maybe once a week or once a month, but you can't do that every day. You gotta sacrifice. You gotta sacrifice to save, man. That's what it comes down to. Okay, option chain on Tesla, and we're gonna wrap it up. Thank you guys so much. I didn't get many questions today, but if you have a question, put it in the comments. You can also message me, Godric, your stock market mentor. The option chain. So we're gonna do the cover call, and it's October 2nd, 2023. So we're gonna do November. Remember to click on all. The range is all. U-chain. Okay. 45 days of expiration. That's 7 weeks. What happened? November. Here we go. 7 weeks. The share price is 251. So I talk about a sweet spot, which is we're gonna write the cover call where the share growth is equal to the premium we're gonna get. The share growth meaning the distance between the share price and the strike that we write. And if it's the same amount, I call it the sweet spot. Like for Tesla, let's see if we can do it. 251. So like 260 is 15. That's too much actually. 265 is 13. So 251 and 60 cents. 265 is about 14.40, and then the premium is 13.20. So that's very close to the sweet spot. So we're gonna do the one. We don't need to do two different cover calls. So cover call Tesla 265 pays 13.20 by 13.35. What does that mean? So I pay $13.20 per share for the cover call. Like my analogy on the cover calls is like if you're an apartment owner and you own apartments, you can rent out the rooms. An apartment owner rents out the rooms for a monthly fee. for monthly income. A shareholder has blocks 100 shares and rents out the shares for a monthly fee, which is a cover call premium. See that how that works? $13.20 per share, or $1,320 per 100 shares. $1,320 for $25,160 investment. $25,160 get your 100 shares of Tesla. Buy their shares today or tomorrow, or at the cover call. In this case, the 265 for 1320, which is the bid. And our share growth is potential 1440. 1440? Yeah. No, 1340. 1340 share growth, and then 1320 premium. So that is the sweet spot. It hit it right there on the nut. All right, so $1,320 is gonna like almost pay your mortgage. It's gonna almost pay it's probably pay all your food, pay your car note. You know, it depends on your bills, obviously, but this one is nice and balanced. So we're just gonna do one. If you have 200 shares, it'll just double up, right? But let's do the math on this. Get ready for this math, you guys. Tesla's going to trump both Apple and Palo Alto. And I'll show you 13.2 divided by 251.60 equals 5.24%. So 5.2, I'll just say 5.2%. Because you're probably screwed up. You'll still do good though. And then if that's a 7-weeker, you multiply that times 7. Because there's 7, because if you go, If you go 52 weeks divided by 7, it means you can do 7 of these trades a year. You get 7.4. I'm rounding down to 7 because that 0.4, that's your extra time to do whatever, whack off. So 7 times 5.2%. 36% per year. Done. That means that 100 grand gives you 36 grand a year. A million gives you 360 grand a year. 0.4. 25,160 gives you 1,320 per cover call per 7-week period. It's probably around 1,000 per month if you go every 4 weeks. We did these cover calls last month. I think Tesla was around 4.85%. This one's showing 5.2. Still great, even though the trade is longer. I hear people trying to do weekly cover calls. It's very tiresome, very just more mental gymnastics, I say. So just do the monthlies. Just do between 3 and 7 weeks. Don't do the weeklies. Don't mess with that. Select your very best stocks. Did I do the ratings for Tesla? Let's do the ratings and we'll wrap up, guys. How's that sound? Thank you, guys. Thank you for Ash. Welcome. Lamb, Ashley, welcome. Giving some likes. We're doing Tesla stock right now on the cover call, in this case for November. The strike price of $265, which is a great cover call, bringing in $1,300, $1,320 per cover call. Investment $25,160. This is like a 7-week trade. You do it every 7 weeks or sooner, but the numbers we have here are 7 weeks. Because we're going from October 2nd to November, the 3rd week, which is like November 17th, which is like 7 weeks. Tesla, let's look at. I told you they're having some slack about having to dig through lithium mines with burning through just guzzling gas to get an electric battery, right? But hey, they're environmentally friendly. All right. Smart Score, Tip Trends. Okay, check this out. They give it a 5 out of 1 to 10. That is honestly it's pretty low for Tesla. I mean, look at this. They're hating on Tesla. Research team reduce. New constructs. Fourth rank at a 5. So there's 2 red flags there. The street is a whole, so neutral. CFRA is a 4-star at a 5-star, so good. Ford Research is a 3, which is neutral. And the market edge is the ballbuster, is avoid, of course. So we got 1 good rating, 1, 2, 3 neutrals, and 1, 2, 3 negative bad ratings. So 1, 3, and 3. So Tesla actually, they don't like Tesla, these guys. I have to disagree, but we'll see, man. We'll see where it is next year or the year after. Thank you guys so much for joining me. I appreciate you. We're doing Monday night stock market. I'm going to cover, some great stocks. Send your stock to me. I will review it. Give me your stock symbol. Message me. Meet me Monday night. Give me some likes. Give me some follows. I will answer your questions best I can. Thank you for joining. Godric out.